There are several assumptions that underlie the basic principles of capital budgeting. Particularly, the analysis is based on cash flows, not accounting measures. Only real benefits and costs that generate cash flows should be measured, in other words, intangible benefits and costs are neglected. It duly considers the timing of cash inflows and outflows. It takes into consideration opportunity costs, which are cash flows that are foregone by the firm if it undertakes the investment. For example, a firm that builds a factory on land it owns would have to forego the rental income from that land, which represents an opportunity cost. It considers taxes, and cash flows are analyzed on an after-tax basis. It ignores financing costs in the cash flows since such costs are accounted for in the investment's required rate of return. If financing costs are reflected in both the cash flows and the discount rate, then the analyst would be double counting them. The discount rate can also be called opportunity cost of funds and the cost of capital. It considers that accounting net income differs from economic income. While accounting net income is calculated after non-cash charges and interest expense, economic income does not deduct interest expense and consists of the cash inflows plus changes in the company's market value. Now, let's go through some of the primary concepts of capital budgeting. Sunk costs, which are costs that have been incurred and cannot be avoided, are irrelevant to the decision of whether to accept or reject the project. For example, the fees paid to prepare a feasibility study of the project are considered sunk costs. An incremental cash flow is the difference between the cash flow if an investment is undertaken and the cash flow without that investment. Incremental cash flows should be considered in the analysis. An externality is the effect that the project, if undertaken, could have on another project or division. Externalities can be positive or negative. For example, if the introduction of razor blades is expected to positively affect the sales of the company's shaving cream product, the blades would have positive externalities. Conversely, cannibalization is an example of a negative externality, wherein a new product leads to a reduction in the sales of another product of the firm. Externalities should also be considered in the analysis. A conventional cash flow pattern is one in which cash flow signs change only once over the project's life. As an example, a 4-year investment would have outflows in years 0 and 1, followed by inflows in the last 3 years. A non-conventional cash flow pattern occurs when cash flows switch from positive to negative several times. In other words, signs change from positive to negative, or vice versa, more than once over the project life. Let's take an example. A company plans to develop a diet version of its soft drink product. The firm paid $20,000 for a market feasibility study to evaluate the project's viability. The new product would be expected to generate $150,000 in annual sales. However, $30,000 of the company's existing soft drink would be lost as some customers will shift to the diet version. In order to produce the new product, the company will have to use a piece of equipment that it currently rents out for $25,000 per year. The company would also need to borrow $300,000 from the bank to cover part of the production costs. The interest would amount to $15,000 per year. What cash flow should be included in the allocation analysis? Well, the cost of the feasibility study is a sunk cost since it has been already incurred and is not affected by the investment decision, so it should not be included. The annual sales of $150,000 should of course be included as an inflow. The lost sales on the existing product represents a negative externality or an instance of cannibalization, and therefore, should be included as an outflow. The rent from the equipment would be lost if the project is undertaken, and therefore represents an opportunity cost, which should be also included as an outflow. Finally, the interest expense is a financing cost that should not be included in the cash flow calculation. Find the full introduction to capital allocation video on www.cognivisio.com.